Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing position sizing part 7, optimal fixed fraction trading. In the previous video, we have discussed the virtues and drawbacks of the Kelly criterion, but the Kelly criterion formula is valid for fixed outcomes, such as bets, in which the gambler wins or loses predefined amounts, and the probability of success is known. In today's video, we are going to explain Ralph Vince's Optimal F. Optimal F is Ralph's way of applying the concept of optimal fixed fraction to the markets. Investing in the markets generates a sequence of wins and losses. If the sequence has a positive mathematical expectation when using the normalized risk unit, there exists an optimal fraction between 0 and 1 as a divisor of your biggest loss to bet on each and every event. Ralph Vince, The Handbook of Portfolio Mathematics. Many people think that the more you bet, the more you're going to make. That is true in risk-free investing, but it is evident that if you risk 100% of your capital in a trade and lose, you're losing all of your funds. As we have seen in the previous video, there exists an optimal bet size that creates the highest multiplier for your initial capital. This value is different for strategies with distinct parameters. The figure below shows the return curves of 2 games after 100 bets. The first blue one corresponds to the fair coin toss game with a 2-to-1 payoff. The amber curve corresponds to a game with a 30% winning percentage and 4-to-1 payoff. We can see that the top curves representing the optimal fraction to trade is different as expected. How to find the optimal F under market conditions? As stated, the Kelly criterion is valid when the size of the payoff and probability of success is known. When it is not, such as in trading, the procedure to find the optimal fraction is making iterations of using different bet sizes to determine the historical best value. Ralph Vince proposes to find it using the geometrical mean. He calls HPR to return of a single trade. These equations are shown here. And thus, the geometrical mean is the nth root of TWR, where the n is the number of trades. This geometric mean is the growth factor of the strategy. By looping through f values between 0 and 1, we can find the f of which GM is the highest. The graph represents the same 2 games shown previously, but depicting the geometric mean curves for the different fractions from 0 to 1. Values below 1 represent negative growth factor, meaning the trade size leads to the loss of capital. Doing this on Python is straightforward. To summarize, we can take a list of trades of our trading system with a standard 1 unit position size. We create a loop from 0 to 100 to compute the individual HPR of the trades using the different fractions. We compute the HPR for each trade fraction. We compute the geometric mean. We find the optimal F, which is the fraction that delivers the highest GM. Once found, we compute the optimal trade units using the following formula. This means to trade 1 unit for every $500 in cash balance for your trading account. We see that the optimal fraction is a divisor of your biggest loss that gives you the dollars needed in your account for every unit of trade. In the next video, we will continue discovering the properties of optimal F. Stay tuned. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.